Greetings, traders, and welcome back. Thank you for joining me for another In-Depth with Chris episode. In today's discussion, we will be talking about hedging, and I'm not referencing that fun activity that your neighbor likes to partake in on your relaxing Sunday mornings oh so early. Instead, no, we are talking about how hedging pertains to the finance world. It's a way to potentially mitigate risk. Even people that are unfamiliar with trading have probably heard the phrase hedge your bets. That is, in concept, the goal of which we will be talking about today. We're going to talk about how it works, where it came from, as well as provide some examples of how to hedge. Now, without further ado, we're going to dive on into it. But remember, if you are planning on passing the Gauntlet Mini, then risk mitigation is this type of stuff that you should be oh so excited to hear. So let's get going. No matter what we do when we are trading, we are always subject to some degree of risk, which is why we are always searching for ways to potentially offset or mitigate some of that risk. The less risk that we can eliminate without affecting our potential reward scenario, usually the better off we are. So hedging is one of those activities that traders can engage in to potentially mitigate some of that risk. Well, what is hedging? Well, hedging in finance is a strategy that's used by investors to insure themselves against downside risk of an investment by taking another investment that is going to offset that possible loss. Essentially, the investor hedges one asset by trading in another to limit the risk of the larger negative effect on his or her finances because of the initial investment. Of course, this does not mean that hedging can help the investor avoid all negative impact. Instead, it means that it may minimize the losses incurred. The way that this is done when it's executed properly, the operational and strategic benefits of hedging can spread farther than merely just avoiding that standard financial distress. It can also open up options for the investor to preserve value and even to create more over time. When hedging is done incorrectly, obviously it can lead to the same scenario as when any style of trading is done incorrectly, which usually results in some degree of losses. The history of hedging dates as far back as 1949 when the term hedge fund became more popularized. That was when almost all investment strategies at the time involved taking only long positions. Then, a Fortune magazine reporter named Alfred Winslow Jones published an article highlighting how investors could achieve potentially higher returns if they implemented hedging as an investment strategy. This birthed the Jones investing model. To prove his hypothesis, Jones launched an investment partnership that utilized both short selling and leverage in his strategy. The aim was to limit risk and enhance returns at the same time. Jones obtained exceptional results through his hedged approach, outperforming the top mutual fund at the time by over 85% net of fees. This success captured the interest of high net worth individuals who then began to look into hedging and hedge funds. Over the years, the concept of hedging in finance has evolved greatly. It even expanded to include the system by which global exchanges can perfect and improve and preserve the integrity of commitments made in forward contracts. So how does hedging work? Well, the concept of hedging is relatively simple. We could use an analogy of car insurance and buying a car as an example of hedging. So if we were to say that someone just bought a car and then decided to purchase car insurance, this does not prevent them from ever being in an accident, but it reduces the negative financial impact should an accident occur. That's the idea of hedging. The point is to use two different counter sides of something in order to minimize the potential detriment of something going extremely far in one way or the other. So if we were to say that we own XYZ stocks in our portfolio and we believe that the company has great long-term potential. So company XYZ is going to be the share of stocks that our portfolio is entirely made up because we don't know anything about diversification at this point. We're new traders. We'll pretend that. Well, we're going to say that we're concerned about the potential losses and we don't really know what we can do against it. Well, we end up hearing that there's a company called ABC, and ABC does the exact opposite stuff at most situations that XYZ does. The whole company is based in a sector that is going to generally go up when XYZ is going down. So in order to offset our investment risk of XYZ, we can also take advantage of buying ABC. So what happens in this situation is if XYZ does go down, and it goes down quite heavily, that should mean in theory that our ABC, due to their inverse correlational properties, should be going up, and that the gains from the ABC going up should hopefully offset some of the losses gained from or attributed to XYZ going down. That is the general concept of hedging. It's a very powerful tool, and honestly, I don't feel that new traders utilize it or are aware of it enough. So I'm hoping that those of you that are just getting into trading, even if it's long-term investing and not futures trading, this is definitely something to take and put into that trading thought book where you're going to come back and think about some other wonderful ideas in the future. Now that we know what hedging is, as well as how it works, let's talk about where it can actually be applied. What sectors can hedging become useful? Well, the first one is going to be commodities. Commodities, any traded commodities such as energy products, agricultural products, precious metals, will most likely have another counterparty commodity that can potentially offset the risk with an inverse correlational factor. So commodities can obviously be hedged if you have two inverse correlating products. Then we have securities. Securities are generally in the form of shares, equities, indices, funds. Investors can even purchase securities without taking physical possession, so it makes them easily tradable, and once again, securities absolutely can be hedged. Then we have currencies. This is the foreign exchange world market. This is the currencies like the euro dollar, the pairs out there. We can hedge currency pairs, or we can hedge currencies themselves by themselves. Either or, doesn't matter. You will find inverse correlating markets in this sector as well. Then we also have interest rates, and it should be no surprise that interest rates are quite similar in the way that they have potentially inverse correlating properties, just like the currency world. So once again, interest rates could be things like the lending and borrowing rates of whatever particular country or whatever is being currently released, as long as we're aware that it's inverse correlating. Then we have weather. Even weather can be hedged. And how does this work? Well, there are weather derivatives markets that offer relatively low risk and high probability events. And once again, these can be hedged if you are interested in hedging something as crazy as the weather. Let's take a moment to talk about some examples of hedging with both futures and with options. First, we'll talk about futures. Let's assume that we own a successful bakery, and we're very concerned about the rising price of butter that we use in our wonderful pastries. Well, we can hedge against the unpredictability by entering into a futures contract, allowing us to purchase the butter at a specific price at an agreed upon future date. If the price has risen considerably, the price of butter that is, by the contract expiry, well, the hedge of the futures contract will pay off. That's because we'd be able to get the butter at the price at which we enter the futures contract, which is lower than the current market price at that time. But if the price is going down, and it's a clear representation of one of the downsides of hedging, if the price of butter has dropped by the expiration date, well, we are once again obligated to pay the original set price by the contract. So in this case, we would have been better off not hedging in that scenario. But hedging can allow us to not worry about what happens to the price of butter when we're holding on to the futures contract as much as we would if we were just outright wondering what would happen in the future. Then with options. An options contract is really not too much different from a futures contract. The main difference is that in an options contract, you're not obligated to execute the contract upon expiry. You have the option to buy or sell that asset at a set future date. For instance, if we were to say that we owned Amazon stock and we are reasonably bullish on the company's growth, but we are bearish on the e-commerce industry, what we can do to protect against downside performance in our shares is to purchase a put option on Amazon stock. This gives us the right to sell Amazon stock at a specified price called the strike price at an agreed upon later date. That way, if the market value declines like you feared and goes down below the strike price of the option, we'll earn some money back with the profits from the sale of the put option. That's because it will increase in value. Or we could exercise the option, which would allow us to sell your shares at the strike price, which is now higher than the market price. So once again, a good scenario for us. In the investing world, diversification is commonly used as a beneficial term. It's the idea of not putting all of our eggs in one basket. That way we're not exposed to catastrophic failure if our one thing has a terrible day or a terrible news event comes out pertaining that one indice or that one asset or whatever it is that we're invested in on. So diversification is always a good thing. And with hedging. Hedging is a concept that is essentially encouraging diversification. We are investing in an opposing asset, something that is going to be an inversely correlated product or an inversely correlated market, something that generally is going up during the time that something else is going down. So the concept of hedging is the process of diversification, and that is a good thing. Averaging down is a simple yet quite effective strategy when it's done correctly. Now, I'm going to preface this by saying that in the investing world, this is something that I strongly encourage only those with strong market experience to start to play with or to start to experiment with, because the concept behind averaging down is really very simple. If we were to buy something up here and the price was, say, $50, and then it falls down to, say, $40 down here, and we buy more of it, what have we done? Well, if we bought say 100 shares at $50, then we bought another 100 shares at $40, that means our average price in the market is now $45. It is just averaging the distance. So as the market falls, when we buy lower, it brings our overall requirement that the market needs to go up to put us in profit to a lower and more achievable number. If we didn't do this and we just kept all of our shares at $50 and the market were to fall to, say, $30, well, in order to recover to profit, we need to regain $20. But if we bought lower and our average price had been averaged all the way down to, say, $35, the distance to get us back into profit is an awful lot lower. So the concept of averaging down when done correctly with good technical analysis or fundamental analysis is a very beneficial tool, but once again, we don't want to just blindly buy because something is falling, because that could be buying the snowball, and we do not want to do that. Another way to continue to diversify risk in the investing world is to implement something called cost averaging. Now, cost averaging just simply means that we are always going to spend each and every month or each and every week at a regular interval, whatever that time frame may be, we're going to spend the same predetermined amount. Say it's $1,000. Well, we're going to spend that $1,000, maybe it's once a month. Maybe it's just once a month that we're going to dump in $1,000 into the market, and we're going to do it on every Friday of, say the first Friday of every month, something, I don't know, after NFP, doesn't matter. But this is going to give us an unbiased average. And what does that mean? That means that we're not getting our emotions involved in trading. That means that we're hedging against potential losses that may be occurring during unfavorable market conditions without trying to get us caught up in a weird speculation effect. This means that we are just totally unbiased and just taking a smooth average over time and sprinkling out all of our investment across that period of time instead of just simply buying all at once. Say we had $10,000 total to spend. Instead of spending $10,000 total in 1 month, if we average it out across, say, 10 months, then we're going to get a more accurate average of that market price. The advantages to hedging are quite long, quite lengthy, and it generally does outweigh the disadvantages, but we'll cover that in just a moment. One of the main advantages of hedging is that it limits potential losses. This is the main upside. It helps us limit or reduce the loss that we might incur because it is going to diversify our risk. Then number two is going to be that it protects profits. In addition to mitigating losses, hedging can also protect our profits by entering into that futures contract like we talked about. Then we have the higher require liquidity across financial markets. Hedging our investments means that we're generally trading in different markets like stocks, derivatives, commodities, and once again, that's going to make sure that we're diversified and keeping our place away from that scary all the eggs in one basket scenario. Then we have that it can be time saving. Long-term investors can save time by diversifying their portfolio and simply just letting it ride out in the long term. That way they don't have to spend time keeping track or adjusting their portfolio no matter the market condition. And then also we have that it protects against unfavorable changes. A successful executed hedge can protect a trader from commodity price changes, interest rate changes, inflation, currency rate changes, and more if the hedge has been done correctly. In terms of the disadvantages, there are really only a couple that we can sum up quite quickly. Hedging requires good trading skills and experience in order to make sure that we're not just shooting ourselves in the foot. In some instances, properly hedging our investments can seem a little bit complicated and be a little bit daunting or dangerous for newcoming investors, which is why we encourage hedging for a more experienced class of investors. There's also the possibility of limited profits because we are essentially going against our position that we took initially. And hedging can also be difficult for day traders with short-term trading because it can be difficult to keep track of the market at the rate that we would need to in two different sectors. So in conclusion, hedging is something that should be very intriguing to newcoming investors, and with good reason. It's a way to potentially mitigate those losses as well as preserve profits. That's what all of us are trying to do on a daily basis as we are trading, aren't we? Now, with hedging, it is something that is more catered towards slightly mid-term to longer-term investing than shorter-term strategies, but it absolutely can be applied. It just depends on what your threshold of excitement and your ability to pay attention to multiple factors entails. But other than that, folks, until next time, if you are going to take that Gauntlet Mini, I encourage you to show me what you've got. Best of luck to you, and I will see the rest of you very soon. Cheers, folks.